Welcome back to our channel. Today, we're diving deep into the world of investing with none other than the Oracle of Omaha himself, Warren Buffett. Ever wondered how to turn a modest sum like $10,000 into a staggering fortune? Well, you're in the right place. Grab your notepads, and let's decode the investment strategy of a lifetime. Before we start, don't forget to hit that like button and subscribe for more insightful content.
Brief history of Warren Buffett.
Born in 1930, Warren Buffett's journey into the world of finance started early. At just 11 years old, he made his first investment, buying shares for himself and his sister. Fast forward through decades of smart investments, and Buffett is now one of the wealthiest individuals on the planet, with a net worth that's hard to even fathom. But how did he do it? Let's take a quick look at the path he blazed.
Deep dive into Buffett's investment strategy.
Buffett's strategy isn't just about picking stocks. It's a philosophy, a way of thinking and living. At its core, it's surprisingly simple yet profoundly effective. Let's break it down, shall we?
1. Value investing.
First up, value investing. This is the cornerstone of Buffett's strategy. It's all about finding stocks that are undervalued by the market. Imagine finding a designer suit on sale for the price of a regular one. That's value investing in a nutshell. Buffett looks for companies with strong fundamentals that are selling for less than their intrinsic value. But how does he determine this intrinsic value? That's where his genius really shines. Buffett's approach to identifying this intrinsic value is both an art and a science. He delves deep into a company's financials, looking at its earnings, debt levels, profit margins, and more. It's like being a detective in the world of finance, searching for clues that reveal the true worth of a business. But it's not just numbers. Buffett also considers the quality of management, the brand's reputation, and market potential. He's not just buying stocks, he's buying a piece of a business. And he wants to make sure it's a business worth owning. Moreover, Buffett doesn't just look for cheap stocks. He seeks quality companies at reasonable prices. This is a key distinction. It's like shopping for a car. You wouldn't buy a cheap car that's likely to break down. You'd look for a reliable vehicle that's worth more than its price tag. Similarly, Buffett finds companies that are likely to withstand economic downturns and emerge stronger. This resilience is crucial for long-term growth. Another aspect of Buffett's value investing is his focus on long-term potential rather than short-term market fluctuations. He often quotes his mentor, Benjamin Graham, saying, "In the short term, the market is a voting machine, but in the long term, it is a weighing machine." This means that while market prices can be influenced by investor sentiment in the short term, ultimately, a company's true value is reflected over time. Buffett's successful investments in companies like Coca-Cola and American Express are testaments to his value investing prowess. These companies were not just undervalued when he bought them, but also possess strong competitive advantages and growth potential. By sticking to this disciplined approach, Buffett doesn't just aim to make a quick buck. He aims to build wealth sustainably over decades. In summary, value investing is not just about finding cheap stocks. It's about identifying undervalued companies with strong fundamentals and potential for long-term growth. It's a strategy that requires patience, thorough analysis, and a keen eye for quality. But as Buffett's track record shows, it can be incredibly rewarding.
2. Long-term focus.
Next, we have Buffett's unwavering focus on the long term. He's not in it for quick profits. No, sir. He's like a patient gardener, planting seeds and waiting for them to grow into mighty trees. This approach requires patience and a strong belief in your investment choices. Buffett's long-term perspective is rooted in his belief that the stock market's day-to-day fluctuations are less important than a company's fundamental long-term growth potential. He famously said, "Our favorite holding period is forever." This mindset shifts the focus from trying to time the market to growing with the market. It's like being on a turbulent sea. Instead of worrying about every wave, you focus on reaching the distant shore. This long-term strategy also means that Buffett spends a lot of time selecting his investments. Just like a master chess player thinking several moves ahead, Buffett analyzes how a company will perform over decades, not just quarters. He looks for businesses that have a moat, a competitive advantage that allows them to protect and grow their market share over time. This could be a strong brand, unique products, or a dominant market position. Patience is also key in this approach. Investing with a long-term focus means resisting the urge to react hastily to short-term market trends or news. It's about having the fortitude to hold onto your investments even when the market is volatile. Remember, even Buffett's investments have seen their fair share of ups and downs. But by staying the course, he's reaped the rewards of compounded growth. Moreover, this long-term strategy aligns with Buffett's philosophy of treating stock purchases as if you are buying into a business, not just a piece of paper. This mindset encourages investors to understand the businesses they invest in and to commit to them, just as one would in a personal business venture. In essence, Buffett's long-term focus is more than just an investment strategy. It's a philosophy of patience, deep analysis, and commitment. It's about seeing beyond the immediate horizon to the vast potential that lies ahead. For those willing to invest the time and belief in their choices, the long-term approach can be an incredibly effective path to financial growth.
3. The moat concept.
Ever heard of economic moats? No, we're not talking medieval castles here. In investment terms, a moat is a company's ability to maintain competitive advantages over its rivals. This could be through brand strength, unique technology, or even customer loyalty. Buffett loves companies with wide moats because they're better equipped to fend off competition and stay profitable over time. The concept of the economic moat is central to Buffett's investment philosophy. Just as a moat protects a castle from invaders, a company's economic moat protects its profits and market share from competitors. Buffett places great emphasis on identifying companies with such durable competitive advantages. These advantages could manifest in various forms. For instance, a strong brand like Apple creates customer loyalty and pricing power. A company like Coca-Cola enjoys a unique combination of brand strength and global distribution channels that are hard for competitors to replicate. Buffett also looks for companies that have cost advantages, which can come from economies of scale, more efficient production methods, or access to unique resources. These companies can undercut competitors on price while maintaining profits, a formidable barrier for any new entrants in the market. Furthermore, companies with high switching costs also create a moat. If a business's products or services are deeply integrated into a customer's operation, like Oracle's database software, the cost of switching to a competitor becomes prohibitively high. The moat concept extends beyond just identifying current advantages. Buffett also considers a company's ability to widen its moat over time. This forward-looking aspect is crucial. He favors companies that are not just resting on their laurels but are actively investing in research and development, improving their processes, and finding new ways to stay ahead of the curve. But why are economic moats so important to Buffett? The answer lies in their impact on long-term profitability. In the fiercely competitive business world, companies with strong moats are better positioned to withstand market upheavals, technological disruptions, and changes in consumer preferences. They are more likely to generate consistent, reliable profits over the years. This reliability is exactly what Buffett looks for in a long-term investment. In conclusion, the moat concept isn't just about a company's current position. It's about understanding the dynamics of its industry, its long-term strategies, and its ability to adapt and grow. For investors following Buffett's path, looking for companies with wide and sustainable economic moats can be a key to unlocking long-term investment success.
4. Invest in what you know.
The fourth pillar of Buffett's strategy is deceptively simple yet profoundly impactful. Invest in what you know. Buffett firmly believes in sticking to his circle of competence, a concept that dictates one should invest in businesses that are within their area of expertise and understanding. It's like playing a game where you're familiar with the rules and strategies. You stand a much better chance of winning. This approach requires investors to be honest about their knowledge and expertise. Buffett himself has famously steered clear of technology-centric companies for many years, not because he doubted their potential, but because he didn't feel he had the necessary understanding to predict their future success accurately. It's about recognizing that being a jack of all trades in the investment world might actually be a risk rather than an advantage. Investing within your circle of competence allows for more informed decision-making. When you understand an industry well, you're better equipped to analyze its trends, challenges, and competitive landscape. This deep insight enables you to make more accurate assessments about a company's future performance. For example, if you have a background in healthcare, you might be more adept at spotting promising opportunities in biotech or pharmaceutical companies. Moreover, this principle encourages continuous learning and growth. As you deepen your understanding of certain sectors, your circle of competence expands, allowing you to confidently explore new investment opportunities. It's an evolving process. You start small, gain knowledge and experience, and gradually widen your investment horizon. However, invest in what you know doesn't mean avoiding diversification. Buffett himself holds a varied portfolio. The key is to diversify within the realms of your understanding or to put in the effort to learn about new sectors before diving in. It's about striking the right balance between playing it safe within your knowledge area and stepping out to explore new, well-researched opportunities. In essence, investing in what you know is about leveraging your unique insights and experiences to make smarter investment choices. It's about recognizing your strengths and limitations and using that self-awareness to guide your investment decisions. For Buffett, and for any investor looking to emulate his success, it's a fundamental principle that combines prudence with the pursuit of growth.
Turning $10,000 into millions.
All right, let's get to the juicy part. Turning $10,000 into millions sounds like a dream, right? But with Buffett's strategies, it's more achievable than you think. Here's the breakdown.
1. Start early and invest regularly.
Time is your best friend when it comes to investing. The earlier you start, the better. Compound interest works wonders over time. Imagine planting a tree. The sooner you plant it, the longer it has to grow and bear fruit. The same goes for your investments.
2. Diversification is key.
Don't put all your eggs in one basket. Diversifying your portfolio reduces risk. It's like having different types of crops in your farm. If one fails, the others could still thrive.
3. Reinvest your dividends.
Here's a pro tip from Buffett himself. Reinvest your dividends. This means using the dividends you receive to buy more shares. It's a cycle of growth that can exponentially increase your investment over time.